Maybe one day I'll wear these, so you can all laugh at me. Hello, welcome back to the channel, and this one we're talking about stock terminologies and the basics around that. So if you're looking at articles and Twitter posts, etc., you just don't know what words mean, perhaps this will help you. So let's jump into it. Before we jump into the actual terminologies, make sure you hit the subscribe button, especially if you're a beginner investor. I do investing content, trading content and finance-based content. So that's something you're into, obviously hit subscribe, and if you do like this video, smash the like button, I do appreciate it. So stock terminology, what is that? So it's basically different sayings within the stock market. Some things including bull, bear, rallying, volatility, volume, and all of that we're going to cover in this video. And we're just going to jump into section 1 straight away. There's 5 different terminologies in each section, and yeah, let's just jump straight into number 1. So in section number 1 we have broker. The broker is basically what you put your money into. So say if you wanted to start investing, you put £100 into a broker. So a broker might be Trading 212, Freetrade, Lightyear, I think obviously you've got in America, you've got Robinhood and Webull and stuff like that. They're all brokers. They all hold your money and they do the investing for you. Number 2 is portfolio. So when you've put that money in, then you obviously have money within the account, and then you can start buying stocks. You can start buying Apple, Amazon, Microsoft, Netflix, all of these stocks you can buy. And obviously the more you buy, the more your portfolio grows. And a little hint there for you, that is your portfolio. It's your selection of stocks. So all your stocks will be kind of in a list. You know, if you have 5 or 10 stocks, that is your portfolio of 5 or 10 stocks. Next up is ticker symbol. Now you might hear this a few times throughout the kind of community, the industry, etc. And this is basically the little code that comes with the stock. So for example, Apple stock is AAPL. So this just basically, if you put it into Yahoo Finance, AAPL, Apple stock will come straight up. It's just a shortened abbreviation, and it's the little code that they use within the stock market. And you'll find this with every single stock within the market. Every single stock will have its ticker symbol. A few more examples might be, so Palantir is PLTR. A more common one, which is Coca-Cola, is KO. So these are a few examples there for you, just to kind of get yourself familiarised with the actual concept. The next up is blue chip. Now this is just basically all your bigger stocks within the market. So Apple, Amazon, Microsoft, Google, these are all blue chip stocks. The big kind of market cap within the stock market are these blue chip stocks. Other ones could be banks and financials, etc. You could call them blue chips. But for me personally, blue chips are just big market cap names. So the last one to end section 1 is volatility. Now this is used quite a lot, especially within the news articles. High volatility, low volatility. What this means is basically the amount that stocks go up and down. So if the stock goes up from 100 to 200, back down to 100, back up to 200, that's an extreme case, by the way. That is very high volatility. And we see this quite a lot within the market these days because there's just so much liquidity, which is another word. It's just basically the amount of money that's been put into the market. But volatility is literally just how much a stock goes up and down. If it's high volatility, it's doing it a lot. And if it's low volatility, it's just kind of going up slightly. Now, typically lower kind of cost stocks are more volatile, so they swing up and down more and more. And then the lower kind of volatility stocks are kind of your dividend stocks, the ones that are meant to be stable. So the ones that kind of go up 1 or 2% per year, they're your kind of low volatility stocks. Section number 2, these ones get a little bit more tricky, and this one, well, not really, this one's kind of fairly simple, and it's bull and bear. So you might have heard the term bull market and you might have heard the term bear market. Literally, a bull market is the stock market going up, and the bear market is the stock market going down. That's all it is. That's the complete difference. So if you hear someone saying, oh, we're definitely in a bull market, it means the market's probably gone up for the last 6 months to a year, if not even maybe longer. So next up is sector. Now this is very kind of interesting. It's basically different areas within the stock market. Now, I'm just going to read off a little list here because there's no way I can remember all of these. So these are all different sectors within the stock market. You can kind of see where I'm getting at. So information technology, IT, financials, healthcare, consumer staples, consumer discretionary, communication services, real estate and utilities. It basically covers the whole of the world, really. And if you break them down, obviously technology will be in there, so that's a kind of industry. But sector is just kind of, think of it like regions. In the UK, you have lots of different regions. Same as the US has lots of different states. These are kind of the states and the regions of that. So they're all basically sectors of the stock market, if you see what I mean. So next up we have dividend. Now this is basically something that a stock pays you for owning a stake in their company. So for example, Apple Apple. They have a dividend yield, and if you invest in their stock, say you put £100 in their stock and they pay 1% dividend, you would get £1 per year. The dividend yields are done yearly, and obviously it can vary from 1% to basically infinite, but mostly it goes up to about 7 or 8. And this could be good for the investors that kind of want to sit back and just put their money into the market and just get those regular payments, whether they can spend it on their children or they can just reinvest it, which is what I recommend. So dividend overall is just something that a company pays you just to say thank you for investing in them. So next up is averaging in or averaging up, averaging down, just averaging in general. This could also be known as DCA, which is dollar cost averaging. I have a video for that in the top right hand corner if you're not too sure what that means or what the pros and cons are, but go and watch that video for a little bit more of an insight of what DCA is. But basically it's just putting your money in regularly into a stock. So averaging in would be putting your money in monthly for a year into Apple, so you're just gradually putting that money in, and then your input goes up, and as the stock goes up, kind of goes in tandem with each other, and that's how you kind of create compound interest throughout the years. Just to dive further into that, averaging up would be kind of due to the price action. So say for example you bought Apple at $100, then it goes up to $200 and you buy it again because you see it go to $300, then that price that you had before, which is $100, would then average up to probably about $150 if the price was at $200. If you see what I mean, it kind of, you bought it here first, you're going to buy it here second, but obviously then that will bring that price up because that will be your average price. Likewise, averaging down is the same thing. This is more typical within stocks. You don't normally average up, but averaging down is more common. So for example, if we reverse that, so Apple, you bought it at 200 and then you bought it again at 100 shortly after, it would then average that price down to about 150. Therefore, in the future, you would make more gains. So the last one for section 2 is penny stocks, everyone's favorite, penny stocks. Now, this is basically any stock that's below $5. That's the general rule. A lot of people do it below $1, a lot of people do it kind of below $10, but for me personally, it's below $5. It makes a lot of sense. And these come with a very high risk warning because they move so fast, because they're lower market caps. The volume could be very low and then very high very quickly. We alluded to that earlier on in the video with volatility. So they're very highly volatile, very kind of risky stocks basically. Now obviously there is advantages and disadvantages with this, but again that's a different video. But penny stocks is basically any stock below $5. So that's the end of section 2. Before we jump into section 3, I would love to ask you to subscribe to this video. I really do appreciate the support. And I'm just going to have a quick sip of my tea before we jump into section 3. So number 1 in section 3 is smart money. Now this is basically just the big boys, the institutions, the kind of the millionaires, the billionaires, all that kind of stuff. They're the smart money, the banks, they're all the smart money. Now you probably heard this term a lot in Audible books and actual books, articles, etc. The smart money does this, the smart money knows this, and it's just people with a lot of money. Next up is volume/liquidity. Now volume is basically the amount of people buying a certain stock. So for example, a stock that I like, very close to me, is NEO stock, and sometimes the volume does fluctuate. So if you had basically 50 million shares traded, that would probably be quite high volume for that stock in particular. But some days you may get 10, 20 million shares traded, and that's considered low volume. Now if you have a look on the chart, I'll stick a picture up for you, and you can kind of see on most charts when you load up a charting system, you have these bars at the bottom of the graph. Now obviously that is volume, so you can kind of track whether people are buying it or not just through the volume. And obviously the more volume they have, the more liquidity there is, if that makes sense. So moving on to liquidity, it's just basically the amount of shares that have been traded, whether it's kind of up or down, doesn't really matter. But the higher liquidity you have, obviously the better chance you have of getting a good price. And going just against that, if you have a low liquidity, you may not actually get into the stock at all. And obviously if you do get into that stock, you may get a slightly worse off price because the spread will be slightly bigger. Which is obviously more aimed at traders, but for now that's kind of what that means. Moving on from that is moving average. Now again, this is due to kind of more in-depth kind of investing, trading, etc. But for example, if a stock is going up, then that kind of moving average line will kind of follow it up. Again, I'll stick a demonstration on the screen for you so you can have a look. And that line following it up is called the moving average. This just kind of shows the kind of consistency with how a stock moves. And like I said before, it is more aimed at kind of swing traders and day traders, etc. But it's always nice to know that kind of what that means. So the second to last one is IPO. Now this means initial public offering. Now this is basically when a stock becomes live. So for example, maybe if I invented a stock called Laptops Are Us, That's terrible. But if I did start that company and I needed more money to kind of grow the company, I would add it to the stock market. Obviously, there's lots of different processes you have to go through to do that. But then if I went on there, that would be an initial public offering. And then people like you, me, would be able to buy the stock, and then everyone would be having a great time. But Laptops R Us is never going to exist because it's a terrible name. Now moving on to my last term, is actually rallying, everyone's favourite rallying. Now if you've heard the term rallying within the stock market, you think, what on earth is the stock rallying? Why is the market rallying? What does that mean? It basically means the stock market is going up, it's going to the moon, it's going green, it's going very much to the right direction. I don't know how many other ways I could say that, but basically the stock market is going up, that stock is going up, it is rallying. So there you have it, they're the stock terms. If you have any more to add, then stick them in the comments down below. If you have any questions about any of the ones I've mentioned today, stick a comment down below. I really do appreciate the kind of interaction, the kind of feedback, etc. And with that being said, obviously subscribe to the channel and like the video if you did like this video. It really does help me in my growth of this channel. I'll see you in the next one. Take care, invest safe, and I'll see you soon.